Hey everybody, welcome to Mortgage Today for Tuesday, August 8th, 2023, and oh, what a day it was. MBS were up 19 basis points bright and early this morning. Stocks lost 31 points in the early hours of trading. The U.S. trade deficit shrank in June as imports slid to the lowest level since 2021, reflecting more moderate consumer demand for merchandise. The value of total imports declined 1% to the lowest level since November of 21. Exports eased by 0.1%. The shortfall in goods and services trade narrowed by $2.8 billion to a three-month low of $65.5 billion, according to the Commerce Department. The figures aren't adjusted for inflation. The median estimate in a Bloomberg survey of economists called for a $65 billion trade deficit. We also had a lot of Fed speak. New York Fed President Williams sees the Federal Reserve policy remaining restrictive for some time. The Fed Governor Bowman said that additional rate hikes will likely be needed. Philly Fed President Harker suggested that the Fed may now be patient and not hike in September, but doesn't expect any cuts anytime soon, and we will avoid a recession. However, Fed Governor Bowman wants more rate hikes. The September Fed funds futures agree with Harker's sentiment, seeing only a 12% chance of a rate hike. The NFIB Optimism Index released this morning showed a slight increase over forecast at 91.9. Business owners continued to report inflation as the biggest problem in operating their business, although owners did expect better business conditions over the next 6 months and also pointed to a difficulty in hiring as a top concern. Friday's big rally in response to the job report seems to have cooled off the excess momentum toward higher rates seen last week, but it's important to note that we're not seeing a heroic reversal back down to lower rates. As the new week begins, traders look receptive to the suggestion from the upcoming auction cycle, especially Thursday's CPI data. When the market is sensitive to potential changes in Fed policy stance, it's not uncommon to see stocks and bonds win and lose together. When markets are reacting to some expected risk in the economy, it's normal to see stock prices and bond yields move lower together or higher together. Today is a better example of the latter, the proverbial risk-off trade and or flight to safety. Following a slew of bank downgrades from Moody's, some would say that the weak economic data out of China contributed, and they may not be wrong. However, today certainly isn't the first day of recent memory of disconcerting data out of China, and none of those recent examples prompted as big of an overnight rally as we had today. At the end of the day, bonds closed up 8 basis points. Stocks lost 20 points at 98.97, which is where we closed out at. It's just below this 25-day moving average, the downsloping red line there, which puts us in this very volatile range with a floor down at 98.716. We also got news that the Federal Trade Commission has agreed to drop its challenge of ICE's proposed deal with Black Knight Inc. in a joint stipulation that allows them to work towards a settlement. If you remember, this is after they actually divested a bunch of their assets, including Optimal Blue. We also got a post from our sponsor at wellthatmakesense.com. So things you actually have control over are your influence. So we talk about the 4 steps of influence, numbers 1 and number 2. First, our brain is there to protect us against the threat of death so we continue to live and procreate. Second, our brain wants to make sense of the sensory inputs we receive. So these are a couple of things you need to understand if you're looking to influence, whether it's coworkers, employees, or your clients, or heck, your kids.